saying now is the time. I'm on the highway, I'm on my way. You gotta try me on tonight. Ooh. This time I ain't gonna. I'm so lucky I can conquer the world. There's so much love in the air. I'm so lucky, wanna shout it all out. We're gonna find our way this lucky day.
Good evening, everybody. Welcome to this evening's webinar. This is the second webinar we've done and the final one today. We ran one early on this afternoon and we're now running the final one today. So first of all, a couple of house rules. First of all, if you're watching on an iPhone or a tablet, I would say that you'll be a little bit behind. The pop-ups or the videos will be a little bit behind, and you'll find that we've got some newcomers coming. So let me just bring these guys into the room as well. So we've got some new guys coming. So might need to take just a few minutes just to get these guys added to the room. Okay, so hi guys, we've got newcomers and people coming all the time. So I'll just sort of wait a few moments before we actually start the content, but we've got quite a few people in the room and there's more people coming as we speak. So I might just need to drop out and add them into the room. But this evening's webinar is going to be very informative. It is aimed at people with a little bit of trading experience. So if you don't have trading experience, please don't worry. We can send you this webinar recorded. So it's actually something that's been recorded this evening and we can send it out to you so you can watch it back at your heart's leisure. But those of you that don't trade or have no experience, we're going to be running some workshops and some videos that we can send you moving forward. So this is aimed at people that have a little bit of trading experience and knowledge. But if you don't worry at all. We're going to cover all the things off this evening, and I'm going to explain to you a little bit about what we're doing moving forward for wherever you are based in the world. So hi Millicent, yeah, hi, it's nice to see you. Ken, greetings to you as well. Greetings Sydney. And it's nice to see people from all over the world here. We've got people in Europe, we've got people in Africa, we've got some people in Swaziland. Still waiting for quite a few more people. We had a full house earlier. We've got quite a few people in this evening. We've got obviously a few more to come as well. So we are recording it so we can always send it out for those that do come late. So this evening I'm going to talk a little bit about a recap on trading. So I'm going to talk a little bit about the basic fundamentals of trading, but then I'm going to leap straight into what ATS does. What ATS is, how we created it, how we designed it, what we designed it for, who we designed it for, and most importantly, how you can use it and how you can benefit from it. So without further ado, let's just get straight into the content. And the first thing I want to talk to you a little bit about is us and myself as a person. So I won't read all this out. I'll just let you read this at your heart's leisure. But I've been involved in trading for well over 10 years now. And I've been involved in the retail trading sector. That is not institutional, not banks, but I've been involved in the training and education of retail traders like you and I, working from home or working on an office or working on a trading floor. And as you can see, I've got a vast experience of working on a trading floor manager, trading and training people all over the world. I spend a lot of time in South Africa. We've just opened an office in South Africa, in Johannesburg, in Nelson Mandela Square. And so I've spent the last sort of 10 years working hard and training and mentoring people in the retail, forex and commodities trading sector. But then over the last 3 years, we've spent most of our time really working on devising, creating and bringing to fruition the product I'm going to share with you this evening, which is the algorithmic trading software, ATS. So vast experience. Us as a company, we are privately British owned. Myself and my wife, we both own this company. I wouldn't be where I was now without her. I hope she says the same thing about me, but we as a business are a privately owned British company. We have a vision to improve the conditions for retail traders around the world. So over the years, I've noticed what's happened in retail trading, and I've noticed weaknesses in what's being offered to retail traders, and that's why we've created this product to help retail traders have their conditions improved and stay in the game longer. We've partnered with some very strong developers. We've partnered with some very strong brokerages. And in essence, what ATS is, and I'll call it ATS if you don't mind from here on in, the algorithmic trading software, what ATS is a interface that sits between you, the trader, and the broker. So it's an interface that sits between the two of you, which executes the trades for you and allows you to then do something else or watch something else or enjoy something else. So yeah, my wife Ritu Kumar and myself, we founded the company a number of years ago, and we set it up with a core vision is to improve client care in the retail trading sector. Our brokerages we partner with, just as a matter of interest, are all STP ECN, which means no hedging. They are straight through processing. They have a vested interest in you trading for longer, as opposed to brokerages that have a vested interest in you losing money. So we move on, and the mission statement of the company is very important. We just got somebody else just joined, so I'm just going to add that person in. I haven't worked out how to do this automatically earlier, but good evening, welcome Joseph. So we've created a platform that all retail traders can use simply and effectively. One where every single trading decision can be made and it's not hedged against you by the broker that you are trading with. It brings back integrity, honesty, and transparency for the retail trader and allow all of this to be carried out 100% automated. And I'm going to talk a little bit about automation this evening. Algorithms are surrounding us all over the world. Our trains these days are driven automatically. Our planes, I've spent a lot of time on an aircraft in this last few months, traveling backwards and forwards to America and Africa, and Dubai and Europe. And most of the time, the planes are being flown automatically. So they're using algorithms to provide the computer that's controlling whatever it is to do what it needs to do. So algorithms surround us. Algorithms surround us in the financial world. And what we've done is we've now brought that down to the retail trading environment, which is something you're going to see this evening. So there's no need to be worried about algorithms. They're very simple to use. And I'll show you all about that this evening. Okay. Just got someone else just joined. So let's just bring them into the lobby as well. That's done. So now we have quite a few more people in the room. So let's crack on with the. Oh, I've got another one. Do apologise, guys. I have to unfortunately add people to the lobby as they come. So you guys that are here early, unfortunately, I'm having to quick jump out and get people added. So let's move on to the next slide. So trading the markets. This is where I'm going to cover a recap on the markets themselves. Okay, I'm not going to spend too much time because I want to spend most of the evening looking at ATS, looking at how it works, showing you how it works, showing you how to use it, and showing you a demonstration of its capabilities. But I just want to recap, and for some of you that have no trading experience, just give you a little bit of a background. So retail trading is what you and I do. We are retail traders because we trade from home. We are not institutional traders trading for a big bank or institution. We're retail traders. Although I am a fund manager, I trade a fund and I have done for many years, we are still classed as retail traders. And it's exactly the same as what the banks do. The banks and institutions all trade the same markets that we do. And all they are doing is predicting the movement up or down of whatever the underlying asset is they're trading. So for example, if they're trading pound, British pound against the US dollar, they're predicting whether it's going to go up or down over the coming hour, week, day, month, or whatever period they're trading. And invest an amount of money into an account and place an amount of money on that trade, on the outcome. So if they've predicted that pound against the dollar is going to go up and it goes up to the level they expected, the trade has been a correct trade, it's been a positive trade, and it's what we call a winning trade. If it goes the opposite way, there's a losing trade. And we have things like stop losses, things called stop losses to stop the excessive loss. So we have certain levels which we place in the marketplace. And that is in essence what retail traders do. So we've got somebody else just joined. So let's just add them in. Good evening, Sarah. Welcome to the party. So I'm recording this. So you guys that have arrived later, we are recording this. So if you've missed the first 5 or 10 minutes, not a problem. We're going to send out the video to you that's recorded from the evening. So we're just talking about retail trading, and it's exactly the same as institutional trading, except that the amount of money that's being traded, Deutsche Bank and Goldman Sachs and the big institutions are trading with billions and trillions of dollars, whereas the average retail trader is only trading with $5,000 or $10,000 or more, or maybe some cases less. In some countries, a lot of people trade with less money, but it's still the same market. So retail trading is what the banks do, but on a much, much smaller scale in volume-wise. So when we compare that and translate that from conventional investing, when conventional investing takes place, the big funds are buying dollar or they're selling euro because they have a huge supply of it, and then they want the price to either go down if they're selling or up if they're buying. They're physically moving the physical currency. And that's the difference between what we're doing as opposed to the big investors. So price has to move in an upward direction for them. If price moves down, and someone's buying to hold, they're holding something that's losing value, therefore they won't be making any money or any profit. So the difference between what we do and what the big investors do is that we can make money in both directions when we're buying and selling. For example, if we exchange our British pound for Japanese yen, and that pair, the exchange rate falls over the coming weeks, then when we exchange our money back, we could get more money back than what we originally exchanged. That's in essence how currency exchange works. But there's a difference between buying and holding and just buying and selling based on the movement of the price. So how does this translate? Well, let's say we are traveling to Japan and we're exchanging our pounds for Japanese yen. We then travel. So we would look at buying our Japanese yen here. And when we return 6 weeks later, the Japanese yen rate has gone up so much. If we had any Japanese yen left here, we would get back a worse rate than when we exchanged it in the first place. So had we had much yen back, we would be selling it back against the pound for a worse rate than what we originally had. And that's in essence how currency exchange works. If you were just buying to use, we can make money in that move as a currency trader. And that's the point I'm trying to make here. On the contrary side to that, we have, let's say we live in Europe and we want to go to Canada. We exchange our euros for Canada dollars here, or Canadian dollars, I should say. We travel and then we return 6 weeks later. The euro-Canadian rate has changed, as you can see here, and the euro has weakened against the Canada dollar. So if we had any Canadian dollars left, we would get back more euros than what we would have exchanged in the first place. And that is what we call a carry trade. It's something that's been going on for years, but you do need an awful lot of capital to be able to benefit from things like this. This is why the beauty of the trading, retail trading sector we're involved with allows you to make money, but from smaller amounts and smaller accounts. But if you're looking to invest a fair amount of money, 20, 30, 40, 50,000 or more dollars, then you can still make the same sort of returns. But that in essence is how that all translates into real terms. So I'm going to recap quickly on what a pip is, because we're going to be talking a bit about pips when it comes to trading with ATS. But a pip is what we use as our trading currency. A pip is a fraction of a cent. So the more positive pips we collect, the more money we make. It's a fraction of a cent. So if you see here, the euro rate against the dollar is €1 will get you $1.4745. That's $1.47, but these are fractions of a cent. And the fourth decimal place is what we call a pip. If it goes from 1.4745 to 1.4746, that has moved 1 pip. And that's the same for all currency pairs, unless we're dealing with the Japanese yen, in which case the Japanese yen is very simply to the second decimal place. And pips allow us to capitalize on even the smallest movement in the market. So if you were buying dollars for your euros and it went from 1.4745 to 1.4765, it's not going to make much difference to the amount of money you'd get in your pocket when you exchange, when you're physically exchanging, but that's a 20 pip move. If you're trading that at $5 a pip, for example, you can make $100 in that move it's made. So pips allow us to capitalize on the most smallest movement in the marketplace. And every trade we place will either have a pip take profit, so a number of pips of profit, and a pip stop loss. So every trade we has an entry price, a stop loss price, and a take profit price. And pip stands for percentage in price or price in points. So moving on, how price is plotted for us to see. So we have charts. We have charts that show a level of time, and we have charts that show an exchange rate. So the current exchange rate, and the price is moving all of the time, 24 hours a day, 5 days a week. And we're plotting price using bars, a green bar or a red bar. These are what we call green OHLC bars or red OHLC bars if the price has fallen in the period it's calculating. So we also have what we call candlesticks, and candlesticks look like this. They're the same thing in essence, but the body here has been filled in. That's the only difference between the two. Every bar or candlestick has a high, a low, a close, and an open. So it opens here, moves throughout the day or the 15 minutes or the 5 minutes we're trading or we're looking at, and then it will close and a new bar will form. So in essence, we can trade on various different time frames, and whichever different time frame we're trading, whether that's a 1 minute chart. So if we're trading on a 1 minute chart, every candle will last 1 minute. If we're trading on conversely on the other end, we're trading on a daily chart, every candle will last a whole day. So they're much longer. But in essence, we're looking at bars or candlesticks and the patterns they create in the marketplace so we can create a trading strategy to get in and out of the market, which is what trading is all about. We eliminate the guesswork, and that's what trading really should be all about, not guessing. So let's look at a trading chart, okay? So a trading chart looks specifically like this. This is XStation. This is the charting platform that we use. This is the charting platform that is the interface that we have created between yourself and the broker that you see here. So this is the charting platform where the trades that ATS place will be placed on this chart. So if we just scroll through one slide, you'll see here that we have price and we have these candlesticks. Can you see these candlesticks going up and down all day long? And here's the price on the right. And you see the fourth decimal place is the pip. So if price moves from there, 1.1358 to 1.363, that's just a 5 pip move between there and there. Let's move on and look at some other areas of our charting platform. So as we can see here, we've got our trade terminal, and our trade terminal shows you the currency pair we're looking to trade, the sell and the buy button, and the stop loss and take profit levels, and the current price volume that you're looking to be trading, okay? So in conventional manual trading, you'd be clicking the buy button or you'd be clicking the sell button to go in and out of the market once you've seen an opportunity that you want to take. Now, just so you know, if you want to ask any questions, you've got a little chat button at the bottom here. If it is a question you want to ask, if it's relevant, I'll answer it there and then. If it's something I'm going to cover later, I've got no problem in covering it later, and I'll just let you know. And then at the end, we'll do a little Q&A if there's anybody that has any questions to ask about what we're doing and how we're moving forward. So let's move on to the next slide about the charting platform. This is where you look at your trade terminal, which is where your open positions are. So if we click here, you can see that any open positions you are open with, it will say here API. Okay, this is the open origin of the trade, which means that it's used ATS by Tradinsights ATS to actually get into the trade by using the strategy builder, which I'm going to show you later. So we've used the strategy builder and the interface, which ATS has programmed to set the trade strategy up. So when the conditions that we've created are met, it will execute the trade, and they will appear on this section here on your charting platform. Okay, different market conditions. So we have 3 different market conditions in any could be at any time period of any time period moving forward. We have what we call an uptrend, when price is generally moving up here. We have a downtrend where price is generally moving down, and we have what we call a ranging market where price is just bouncing in between 2 main levels. The highs aren't really getting any higher. The lows aren't really getting any lower. It's what we call a sideways market or a ranging market, where the highs are getting higher here, it's an uptrend, and when the market's going down, where the lows are getting lower and the highs are getting lower, it's a downtrend. Now, we have trading strategies for all types. We can create trading strategies for all environments. The whole idea is that you know what environment you're in. One of the things we're bringing in with ATS is what we call machine learning. And what that will do, not only will it do what it does right now, which I'm going to be excited to show you later on how ATS works and what it does, but later on we're going to have a situation where ATS will work out what type of market it is in, the market you're in, whether it's ranging or trending, and it will turn various systems on and off automatically depending on the market conditions. So, for example, you may have two strategies that you've created, which we can help you with, of course. One is trending and one is ranging. So when the market conditions are recognized by the machine learning to be ranging, it turns a ranging strategy on. And when it's in a downwards or an upwards trend, it will turn a trending strategy on. And I'm going to show you both types this evening, how this works. But that in essence is the different market conditions that we will be experiencing in the market. And the last thing really for this section is stop loss. Every single trade should have one. I've seen over the years many people try and trade without a stop loss, and the reason why they don't use a stop loss is because they don't want to be stopped out. Your stop loss is your friend. Your stop loss is there to protect you from losing excessively on any one trade. It prevents you from losing excessively, and it is your financial safety net. You're only risking a small percentage of your account on any one trade, and the stop loss will be there to protect you from losing any more of that. It keeps your losses small, and it takes away the guesswork. And I have a saying which I've been using for many years, is if you can keep your losses small, but keep your winning trades bigger with a higher reward to risk, you will stay in the game longer. Trust me on that. And I'm going to show you some results tonight to back that up. So it allows you to traders to stay in the game longer having a stop loss, and it prevents a damaging mindset, wondering how long to leave a trade running, where you might just leave a trade running with no stop loss and it's losing. How much are you going to let it go down by? Are you going to wait for it to come back? It may never come back. So a stop loss is there to protect you. So all of this that we've mentioned so far requires awareness of what you're looking for. You need to look at charts, which we've looked at already, and we've looked at looking to see what you need to do and when you need to do it. We've still got a latecomer coming in here, so let's just add them in. Okay. Good evening. Welcome. Welcome, precious. All of this requires awareness. Knowing what to do and when to do it, looking for trade setup, setting the trades up, entry, exit, the risk management on the trade, pressing the buy or the sell button, watching the trade live and go in and out of profit. Do I close it early? Do I come out early? Do I go in? What do I do? Do I close it if it shows profit? What should I do? It's all about emotion. And emotion can be a negative influence when you're trading because you're then fighting against market conditions. So having the ability to go in and out of the market without having any emotion is a huge, huge benefit. And it's something that people have been trying to create for years. I'm so glad we did. And I'm so glad we had that conversation 3 years ago with some amazing developers, and more on that a little bit later. So what do traders do? So traders study the markets and what they do. They work out where they want to get in and out of the market. They then buy or they then sell, and they work out where they want to put a stop loss. Calculate how much their account they want to risk on the trade. Calculate how much that is in volume, i.e. in CFD sizes, whether that's a volume, whether that's a CFD or a macro lot or a mini lot. Wait for that setup. Make sure they're there to place the trade, or if their broker platform allows them to, put a pending order in, and then next time repeat above. Now, what I'm going to do here is I'm going to share with you a video right now of me typically looking for trade setups. It's not the way I trade, but it's the way that most people do trade. And I'll just share the video with you right now. Just bear with me, please, while I set it up. Hello, I'm looking at some trading opportunities here. and this is a moving average cross strategy that I like to use. So what I'm going to do is I'm going to look to see what's setting up, potentials in the marketplace, either when the 50 moving average crosses the 200 to the upside, or when the 50 crosses to the downside. So Aussie CAD, there's nothing setting up there. So what I'm doing here, you'll see two lines on the chart. We have a moving averages. Moving averages plot the average price or average movement of price. So as you can see, price has been moving, so the moving averages are facing down. These are different time frame moving averages. This is a 50 and this is a 200. So it's actually above because the most recent price movement has been strong to the downside. So what we're doing here is we're looking for when they cross, okay? So when the 50 crosses down through the 200, we see price fall, and when 50 crosses up through the 200, we usually see price going up. So let me just carry on with the video. Quite spread apart. So let's go down to Aussie Swiss. Aussie Swiss is exactly the same. Aussie Yen, exactly the same. Aussie Kiwi, exactly the same. Well, they're a little bit closer maybe, so there might be something to look for in a few hours time. It's currently 5 o'clock in London in the afternoon. Aussie dollar, that one's turning up, so that may be something for the next few hours, so come back to look for. So let's look at that. Let's scroll down a little bit more. Let's look at CAD Swiss. CAD Swiss, yeah, okay. Nothing really there. Let's scroll down. Let's look at some of the other CAD pairs. CAD Yen. CAD Yen's turning up, so that's a potential one. Aussie Yen, same thing. Okay, let's look at some more CAD pairs. Aussie CAD, Euro CAD. Let's look at Euro CAD. Euro CAD, oh, that crossed there. Missed that one. That was at on the 1st of August at probably about 11 o'clock at night. That one, I missed that. Look at that opportunity. Euro CAD. Let's look at some other ones. CAD, pound CAD. Oh look, pound CAD's going sideways, so we don't want to touch that one. Let's look at other ones. CAD. Let's look. CAD. New Zealand dollar CAD. New Zealand dollar CAD. Oh look. Oh, it's been going down for ages. Look. Last one, when was that last one? When did the last one cross? There, look, 12:45 on the 23rd of July. What a lovely move we missed there. Okay, let's look at some dollar yen. Let's look at yen, JPY. Aussie yen. Let's go to the yen. Let's go to the current price. Okay, nothing on Aussie yen. Let's look at CAD. No, let's look at let's look at New Zealand dollar yen. Nothing. New Zealand dollar. Euro Kiwi, let's look at that one. Euro Kiwi went, oh, that crossed then, missed it. That went at 4:30. Let's just auto adjust that. That one went there at 7 o'clock on the 31st of July and made all that profit. Another one we missed. My God. What else can we look at? Let's look at New Zealand dollar, US dollar. Oh, hello, this one looks like it could be setting up shortly. So this one here, so as we know, I use a 21 pip stop, or round about 20 pip stop and a 65 pip target when these spot up. So I'm going to estimate that I need to come back to here because I don't want to put a pending order in, because a pending order is a price level specifically, in which case when this does cross, price could be up here. So I don't really want to put the live trade on yet. I want to wait for the cross and then get in, and that might happen the next few hours or so. So let me risk manage this to start with. So the account size is $35,000. So we're going to go here. We're going to have $35,000. Okay, so what I'm going to do, just make sure I risk manage this properly. Multiplied by 0.5%. Okay, percent, and that equals there. So that's, I'm going to risk $175 on this. Now the stop loss is 20. So divide that by 20. I'm going to be trading this at £8.75 a point. So what I need to do is go into a lot size calculator and get that built into it as a CFD for this particular pair. Okay, so let me just write this down so I don't forget it. New Zealand dollar, US dollar. Probably we said about 10 o'clock maybe this evening, or 12 o'clock. Certainly it's close, maybe midnight. So midnight ish. So I've got to stay up. EMA cross, and let's just write down the numbers so I remember what they are. It's $8.75 a point. Okay, and that's 0.5% risk. Okay, that's the only one we've seen so far. So I'm going to set my alarm, have a little sleep, come back at midnight and see if that's come in and see if that's come, and maybe come back and have a look at that later. But there you go. That's how I would look at trading an EMA cross. Thanks for watching. Okay, I am so sorry to have bored you with that, but do you believe it or not, that is the way that probably most of the retail traders out there trade. They are looking for setups, and they get frustrated because they've looked at a setup and they realize they've missed it because it happened 2 or 3 days ago and they weren't there when that setup was created. So that's the whole reason why we created what we've created and what we're going to share with you guys this evening. You know, and very simply, you know, if you're not in front of your charts when a setup is there, it won't be placed unless you've got a pending system which allows you to put the order in, but that's not going to be relevant because the moving average would have already crossed, or you've got some sort of way of automating it. So the whole idea, as you can probably see now, is that it took around 5 minutes there to look for a potential setup. And that was only 8 currency pairs out of probably 40 or more that I had to choose from. And that's only on one time frame. We have other time frames. We have 1 minute, we have 5 minutes, we have 15 minutes, we have 30 minutes, we have an hour, and it goes on from there. We have a wide range of time frames that we can choose from. So as you saw, I actually missed loads of opportunities. And at that point, there was one possibly where the moving averages were just about to turn on New Zealand dollar against the US dollar. And it was one possibly later that evening or very early the next morning, I would have had to have come back to it to place the trade. I already made a note of the risk calculation. So when I come back, I know how much to place on it. So once I've calculated the CFD size, I mean, without sounding rude, if that's all you know, that's all you know. When you see how simple it is to use ATS and how ATS would have taken all of those opportunities that we missed and would take any future opportunities that will happen in the future without you being there, you will think, why the hell did I do this in the first place like this? And that's the whole beautiful thing about this particular system we've created. So in essence, you know, you're banging your head against the brick wall. It's frustrating because you've missed opportunities. Time consuming because you're looking for them all of the time, looking through all the different currency pairs, looking for all the different time frames, having to write down the settings when you see a potential trade for later. I need to add somebody new in. We get people coming in all hours now. Those of you that have arrived late, we are recording this. We'll send it out to you, so don't worry too much about what you've missed. Time consuming having to write down settings when I see a potential trade for later. Time consuming having to then find time to come back later to see if it's set up in the first place. Is this why people got into trading? People got into trading because they wanted more time to do the things they wanted to do, not spend time all hours God send looking for setups and getting frustrated because they missed them. That is one of the main reasons why I created, or we created, I should say, ATS to allow people to not miss opportunities and not spend hours looking for them. So simplifying it is important, okay? Many years people have tried to simplify that process. We've mentioned pending orders quite a bit. Pending orders are orders where you say to your broker, someone else coming in, where you say to your broker, please, if price gets to that level, get me in. You can't tell your broker if the moving average is cross, get me in, because the broker doesn't know what a moving average cross is. The broker knows what price is. So a pending order is at a price level there, your price is here, and you say to your broker, if price goes from this level to that level, and you give them the numbers, get me into the trade. Then if price was hit, the trade would be placed automatically. It's what we call a semi-automated system. Then came signals, where a system would generate an alert when a particular condition was met. The trader could then react, and if they're available when that signal was created, they could jump on their trading platform and place that buy or place that sell. But again, you have to be there to do it. And more often than not, those signals that you're looking at reacting to cost a lot of money to be actually buying off the shelf. And I get emails day in, day out from people trying to sell me trading signals. Spend $399 on this trading signal. It makes such and such. And to be honest with you, there's no guarantee when I ask them what the results are. So why would you want to spend $300 or $400 on something you don't know even if it works? That's the beautiful thing about ATS. You don't pay anything to use it, and it gives you the ability to test things for yourself before you actually get into the real marketplace. It's really a fail-safe all-in. So let's talk about a bit more about automation, okay? People have tried to automate the entire process. So, okay, there's many ways you can actually automate the process. Banks and institutions have realized many years ago that with technology and spending millions on infrastructure, millions of dollars, they could get somebody to program a computer system to go in and out of the market for them. And I had a conversation probably about 3 or 4 months ago with a guy who worked in the stock market in London at the stock exchange for about 4 decades. And he said to me, he's no longer working there because a computer has replaced him as a trader. And now it's a computer that's doing all of the work that he was doing. Because what they have done, these big banks and institutions, is employed the services of massive infrastructure computers that go in and out of the marketplace. I'm going to show you a video in a minute and show you exactly what I mean by that. But what that does, it removes human intervention and lets a computer think faster than a human to take the decisions for them. Now, as you can see this image here is just one slide of a load of slides of all the signals out there in the big wide world where people are just trying to sell you signals and sell trading signals so you can just plug into any old platform. And I've looked at these over the years, and I thought to myself, there must be a way of doing this simpler, more reliable, more effective, and for no cost. And that again, and I could keep on about it, that is why we've created ATS. Okay, let's talk a little bit about how people out there create signals. Okay, so signals, or what we call EAs, expert advisors, are something you can plug into a platform called MT4. Okay, and I watched the video today, guys, and this video I watched this morning was about 14 minutes long. As you can see, it's a 14-minute long video, and this guy's video was called "How to Easily Code a Trading Strategy." And it was 3 minutes 57 seconds into the video where he'd actually written the bare bones of his strategy on the flip chart. This is what he wanted to happen and when. Okay, so it took 3.5 minutes to actually explain and just get it written up on the board. If we move on to the next slide shows us that he's now written the code on paper to actually show what the code would look like. So if market position equals 0 and open bracket RSI, you get the drift, yeah? This is all about writing out the code or computer code that this strategy that he wants to create is going to use. This is 9 minutes 47. This is 6 minutes later. 6 minutes to write out that code. The next slide shows you 6 minutes later, he's now coming to the end of his video, and he's now really happy with himself that he's actually created the sell condition. So in 12 minutes, 13 minutes, he's gone from a blank sheet of paper to a sheet of paper with the code written on it of what his strategy would look like before he codes it. He hasn't even got to code it yet. He hasn't even back tested it yet, and he's nowhere near running it live. He's just a theory that he's written out to demonstrate how easily it is to code a trading strategy. When you see how ATS works, this guy, and I actually sent this guy a lovely email earlier to say thank you for your video, really was good, but I think you should look at ATS by Tradinsights, because I think what you spent 16 minutes or 14 minutes showing us how to code, we could have actually had a strategy up and running, created, back tested, and running live by the time you'd actually written your first letter on the whiteboard. And I wasn't being cheeky, I'm just being honest, because I think the more people that find out about what we're doing in ATS, the more people are going to realize that trading is not difficult. It's not time consuming. Using the right tools and right functionality, it really is something that you can benefit from. So let's move on. This video I'm going to share with you now is a video of why the banks, or how the banks are doing it.
It's the moment investors around the world wait for, the 9:30 opening of the U.S. markets. Inside Citadel's Chicago headquarters, it's eerily quiet, even though this firm trades more stocks every day than the New York Stock Exchange.
Now, 2 minutes they open, so we're about to get going here.
Is there any equivalent of a bell that we're going to hear or see?
I have a world clock up there. That's about it. We're just going to hear the air conditioning above us.
The equivalent of the NYSE's opening bell is just this. Millions of orders that have been waiting all night for the markets to open are rapidly filled by Citadel's computer programs.
How do the books look, guys? So we're pumping through a lot of volume right now. You can see how quiet it is. The phone's not even ringing. Clients are happy. If there was ever an issue, obviously we would spot it first and the phones would light up. We have executed 21 million shares already.
Wow, and we are not even 3 minutes in. Meet the new Wall Street traders. Here, computers like these do the heavy lifting. Citadel's employees with PhDs in applied math, physics, and engineering build and refine the computer programs. And the people who manage the trading floor here mostly look for computer glitches and talk to customers.
They are not making trading decisions. Those are all made by the computers. So they're not making any decisions with respect to whether an order should be filled, what price it should be filled. That's all done in an automated way.
When you click send from your TD Ameritrade account, there's a good chance that Citadel's computers see it. Then they either fill your order or send it out to the Byzantine network of 13 exchanges and 20 plus dark pools to execute it.
Dark pool is really, it's an unfortunate terminology that the industry created, and really a dark pool is nothing more than a crossing engine. Now it's called dark because the whole market doesn't know what you want to buy or sell.
We've seen these market dislocations. Is it fair to think of it almost as a technological arms race?
Yeah, I think it's no different than any other industry. 100 years ago, there were literally hundreds of car companies across the U.S., and there was a lot of smaller companies. Over time, manufacturing became very automated. You had factories, and you had the cost of building a factory went up. We are a technology leader. We make a big investment in technology to stay cutting edge, and yes, we're constantly investing in our systems to stay at the forefront of technology.
Okay, we're back. So that video shows you how I see someone's got stuck with no volume. You'll find when you get the recording, I hope the volume is okay now. When you get the recording, it will all be fine. It should be okay now, though, I would have thought. Good, excellent. So Algo auto trading, as you saw, there were loads of computer screens there in that Chicago bank where they're just processing loads of orders. Now, we're not doing the same thing here. What we're doing, we're not having loads of screens in our room. What we're doing is we're giving people the same ability to have that system, that automated system, run on a much smaller scale. And as I said at the beginning of this, those of you who missed this, I said at the beginning that the algorithms surround us in the world. Our trains, our planes, and even our cars now. I'm hearing cars becoming driverless. They're being coded to be able to drive and recognize when to turn. Our traffic light systems. We have lots of things now that are automated, and they're automated. They work on an algorithm, a rule. And this is all we're doing is benefiting that from the trading world. So the reasons for algo trading, well, the first reason, as you can see on this screen, is the banks do it. Banks and institutions algo trade for a reason, because it makes them a profit. It's less time consuming. They haven't got to pay staff. A significant amount of a bank's overall profit comes from what we call algorithmic